Hey everybody, welcome to this free edition of our Trader User Group, a weekly roundup for the trading week ending March 31st, I guess, right? End of the month, end of the quarter. Really interesting quarter, 2023. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is March Madness. I mean, there's down here in South Florida, it's great. We got two teams of the four teams in the Final Four. FAU down here in Boca Raton, Florida, and Miami down in Miami, of course. So that's one form of March Madness. Another form of March Madness is what we're seeing in the financial markets. The indexes this week had solid gains. I mean, it's relatively quiet regarding economic data, but we did see Q1 come to an end with the Tech-Heavy Nasdaq moving up 16% for the quarter. It's the best showing for Nasdaq since early or late 2020s. While the S&P is up about 7%. And then the narrowly focused Dow was only modestly higher, but did manage to move back into the green year to date. Bank stocks, which, declined sharply since the banking crisis when we saw SVB, Silicon Valley, and Signature Bank coming under early in the month. We saw them have, or we've seen the banking index really have strong gains this past week. And over the course of March, as I said, March Madness in the markets. I mean, we've seen wide swings in Federal Reserve policy from one extreme to another, from continuous rate hikes before the banking crisis to pausing very soon, all due to issues really experienced with the failure of SVB and Signature Bank and the resultant stress that it kind of permeated across the banking sector, right? If we come over here and let's just take a look at the week here. Just kind of see how things shaped up. If we look over, you can see everybody's in the green solidly for the week and year to date. NASDAQ up over 16%. You can see the forward PE ratio is 18.15. I think that's a little bit optimistic. Members, we'll go into more detail on the earnings forecast coming up for Q1 here, starting off on early April 12th. I think the bank's going to actually lead off the earnings. Dividend yield for the S&P is coming in at 1.7, Treasury at 3.49. Earnings yield for the S&P is at 5.36. It's about 187 basis points over the 10-year Treasury yield. The real yield is still in red, though, okay? And the current VIX, it came down again around 14% to close out the week at 18.52, as I told our members. For the past 18 months, every time the VIX has gotten into the high teens, as an older teenager, it just ripped back up again. So we got to be very careful. And the timing is really appropriate because we're getting ready to come into earnings for Q1, which the bar has already been lowered 4 or 5 times every time they do a new earnings analysis for Q1 of 2023. Markets price it down. We did have this past week even though it was a limited economic data, we did see this past Friday U.S. core inflation, which means we're taking out food and energy. The personal consumption expenditure, PCE, it's kind of the Fed's core gauge. It came in at 4.6%. The expectation was 4.7. And then if we look at the core PCE, it came in at 5.4, all right? Well in excess of the 2% long-term inflation target goal, okay? And then we saw GDP was revised slightly lower to 2.6%. But inflation is still very strong, all right? And Treasury yields took a little bit of a breather from all this March Madness movement that we've seen. But still, they're still higher than normal, but they've come down dramatically. But it's been dominated really since SVB's sudden collapse and then some of the other banking system worries. And right now, like I said, it's a coin toss between raising the rates at the next Fed meeting in early May by 25 basis points versus taking a pause. You can see here the best and worst performing sector for the week were both solidly in the green, best being energy, a little bit of a bounce off the lows that it experienced recently. Technology sector up 21.62%. I'll show you some charts. If you look at Microsoft and Apple, they comprise almost 14% of the entire weighting of the SPX, all right? Huge. So when that market moves up, and especially the FANGs, when they move up, it just artificially moves up the rest of the market now, or the S&P. But if you look at the rest of the stocks in the S&P, they're barely over zero year to date. So we're seeing a concentration of growth here, primarily because of the strong drop in interest rates and the forecast by some big market participants that with the banking crisis looming on the horizon, whether it happens or not, the Feds are going to have to slow down their rate hikes. In fact, start cutting rates towards the end of the year. Members, I'll go into more detail on this with you guys Sunday evening, but that's kind of where the markets are sitting right now. And then, of course, if we go over and we look at the European markets across the ocean, you can see everybody was in the green, from the Euro stocks, FTSE, CAC 40, DAX, all solid in the green. Year to date, solid. In fact, we got CAC 40, DAX, and Euro stocks double digit year to date. The only double digit we've got in the U.S., of course, is NASDAQ, but that's leading the way globally with all the major sectors that we're following. Okay. And you can see that in Europe, we did see that the price growth in the euro area slowed a little bit to 6.9% in March, right? A little bit of inflation coming down, but still still very high. And then the composite index of a lot of economists had forecast 7.1. So it's still coming down, but however, the ECB is still committed to raising rates. The core rate, which excludes food and energy, much like here in the U.S., ticked up to 5.7 from 5.6. So that shows inflation there. Like here in the U.S., is very sticky. Meanwhile, over in the U.K., unemployment's kind of holding steady, but still very sticky inflation. Okay. So, but the forecast for European stocks, I happen to be more prone Euro stocks than U.S. stocks, and more prone to be long euro versus the US dollar. All right, I'll show you the charts here in just 1 minute. And then, of course, if we look at the Asian markets over in Japan, they're now following the US lead in restricting exports of 23 different types of leading edge semiconductor equipment. And they're going to need to get permission from the government to do that. All of this is going to start in play in July. Okay. Outside of that, they're one of the few countries on this planet or in the G7 that's putting money into the economy via stimulus. And you can see here that they were up a little over 2.4% for the week, 7.46, which is big for the Nikkei, up year to date, just in the first quarter. And then if we look at the Chinese markets, we did get their official PMI data. They rose better than expected to 51.9, so over the expansionary number of 50. While non-manufacturing rose 58.2. That's the highest reading we've seen in China since 2011. Of course, China's just coming out of their zero COVID policy, so we're going to expect to see some strong numbers because they're benchmarking compared to last year when they're fairly locked down. Okay. Meanwhile, industrial profits in China fell almost 23% in the first couple of months of 2023. And that was following a decline of 4% for all of 2022. So China's they're gonna struggle. I think they're gonna struggle dramatically. So this is a little bit about what I'm seeing here. And of course, let's just go take a look at the charts here. And if we look at we'll look at the S&P 500 E-mini futures first. And you're going to see here in this chart that it should be showing on your screen right now that you can see this strong move. We were actually in the red back on March 13th. That shows you the wide swing that we've had. And now we cleared this zone here, this kind of a tight zone. We took out a prior pivot high that was made on March 6th, and away we go, right? And I said if we take that out, I would expect a little bit of a retest, and then assuming markets and earnings don't totally collapse, you're going to see us come up and make new highs going into April. And then we may have a little bit of a slowdown end of April into May, and then another rally attempt, and then a little bit of another slowdown. It's going to be very choppy. And if let's just put this back on a weekly basis. I mean, if you look at this, I'm sorry, on a daily basis, but look at the chop here. It's just up, down. I mean, this is insane. For people that are trying to find a trend, it's very difficult to do, right? I mean, if we come back to right about here, which was summer of last year, I mean, we've got these kind of movements, right? And if we just lock it in like this, all we're doing is range bound from about 4,200 down to about 3,750. It's just in this range right here. Now we're going to eventually break out of the range, but we need to get an all clear from the banking sector, and we need to see what the Fed policy is going to be on when they're going to pause the rates and what inflation's going to do. If we break out, that would be the next key level right at 4,300. In fact, a lot of analysts are forecasting that'll be around the high for the year, 4,300, 4,350. Okay. But getting there is not going to be a piece of cake. It's just not going to be, we're going to be chopping around. And I think there's several more downside swings that we can expect in the markets before we get there. So it's been a very difficult market, and you're seeing some short covering in the market with this squeeze that we've seen. And you can see starting at the beginning of the year, we had a strong January, and then a very weak February, and then a counter trend back in March. So it's just up, down, up, down, up, down. And very few hedge funds participated in this rally. So you're getting a squeeze here. And I think that also precipitated some of the move up higher. And if we look at volume right here, and I've got on my volume bar, you can see I've got a purple line and a blue line. The purple line is the 5 moving average. 5-day moving average, and the blue line is 20. So basically 1 week compared to 1 month. Okay. And if you look at the volume of the futures contract, well, it's very simple to see, right? From this low here, when we hit a peak, volume just fell off the table as we moved up. That tells me that a lot of people got short here, and they really a lot of short covering right here. Not a lot of fresh new money. There's still a lot of cash on the sidelines. And I think it's going to wait until we get an all clear signal. And I don't think that's going to happen anytime soon. And that just generates a lot of this kind of movement right here, right? And for swing traders, short-term swing traders, day traders, it's a beautiful market. I mean, if you understand how to day trade or short-term swing trade and lock in profits, especially with options, it's a great time. If you don't understand it, it can be very difficult. Now, I wanted to show you, this is the SPX, okay? And you can see it's up just slightly under 7% for the year. And of course, if we look at, or the E-mini futures, if we look at the SPX equal weight, you can see here, now this is assuming you take out the Microsoft and Apple weighting of 13% or 14% of the entire index, and just assume all 500 companies roughly equal that 1/500th% of the index. This is what it would be. And you can see it's been underwater really since the second week of March, and it stayed underwater until March 29th. So the last 3 days of the trading month, it actually moved into the green, but just barely, by just 1% or 2. Okay. So no one shares the enthusiasm that technology and maybe some of the cyclicals share, or communication services share, that these guys share, right? The rest of the index is flat, essentially. Until we see more breadth and more volume, then we're subject to big moves down. Now, I'll show you the FANG index. This is a custom index that I made here with FANG, and you can see here I haven't even moved it up yet, but it's going to be up almost 31%, right, of the FANG index. Really a strong move up. And this index comprises Microsoft, Meta, Apple, Google, Amazon, right? So it's just those stocks, and they're through the roof, right? I mean, just really very, very strong. And so it shows you just where things are flying out right now, right? I mean, it's showing you how it's doing. And if we come down here and look at volatility, look at the VIX. The VIX here is just slowly slid. I mean, we had an intraday high here of over 30. That was on the middle of March. And the entire month of March, we started off March right about where the VIX is right now. We've gone all the way up and all the way back down again, just in the month of March. And when we get down to these levels in the high teens, so it's an older teenager right now for the VIX, you can expect, at least what we've seen over the past year and a half, pops back up again rather than a drift lower. And I don't think the VIX is going to go much lower until we get the banking issue resolved. And I think there's more clarity on just what the Feds are going to do with inflation. All right. The headline inflation number is coming down. So that's yesterday's news. But where everybody is focused now is how are the Feds going to handle the core PCE, which is their primary follower when you strip out food and energy cost, which I don't know why they do, but they do. 'Cause I don't know that many families that get by without food and gasoline and energy costs, but they do. Strip it out. We're going to see where this wants to go. All right. We're still in, you can see we're in zone two here. Zone two runs in the VIX market from about 14 all the way up to 20. It's very choppy when volatility gets around this area right here. Okay. And so far, the chop has been to the upside, not to the downside. So we're going to see more of that through this year. Right. It's just going to be one of those kind of years. And then, of course, if we come down and look at treasuries, we look at the bond market, had a very strong Friday. Okay. It's nearing the 2023 high, which means interest rates are staying lower. And the reason why is a lot of big bond players and the bond market suspects that the Fed's going to actually be forced to cut rates again. So we're back in that same scenario that we were in January. Remember when markets were going crazy up because the bond market was thinking that the economy is going to get worse as we move through the year and slow down and force the Feds to start cutting rates. So those stocks that tend to do well and fall in interest rates, a la technology and some cyclicals and communication services, is just going to continue on. So we're going to watch the dynamics to see how this changes out. You know, they say it's not a stock market, it's a market of stocks. And that's kind of probably the watchword for the first quarter anyway. Okay. And of course, if we look at currencies, I like the euro long, even though it came down a little bit on Friday. You can see the euro took out a prior pivot. It's coming up challenging. It should say 2023. Let me just change that right here. But it should say 2023 high price for the euro. And you can see the low here, but we're over the key area here, which is the 50 EMA. And then by the same token, I think the dollar is going to continue to go lower, although Friday it had a very strong up day, right? But you can see the dollars in the red for the year. My near-term target for the dollar is slightly below 100. If it takes out 100, look out below. And then with the euro, my near-term target is going to be 111. You can see right up here, right around 111. I think we'll run into resistance up here, but we still have upside here. Remember, I told our members we were getting long back over here in the euro. It was just a great trade. And people made a lot of money in our group on staying long the euro and then taking some profits. But then we had another signal to go long over here as we're moving back up again. And I think longer term, the euro is a good place to be. Okay. Gold reacts to interest rate moves, right? When the banking crisis hit, you can see right over here, as soon as the SVB and then Signature Bank, everybody wanted to get into gold, just like Bitcoin. And now we're doing a red, green kind of candle. As interest rates come down, you're going to see gold's going to be competing for money with equity markets. And most money right now, and I like gold longer term to the upside. All right. I think we're going to have a lot more stress in the markets, just not near term stress. But you can see it was the high for gold was on March 20th when it actually went to 2014. I think gold needs to peel back a little bit, settle, and then on a pullback, I would be a buyer of gold. Right. I mean, that one to me just seems like where you want to be in the precious metals market. And then, of course, and by the way, also silver. All right, silver is another that's got a higher beta, so it tends to move a lot faster. But silver, as you can see here, we sat up here literally from early December to February. So almost 3 months of just sitting here going nowhere in silver while gold was moving up and down. And then down here was more of a buying opportunity for silver, and then away we go. Right. And then silver is going to chop here for a while, like I think gold will chop. This would be a good way to trade gold the way we trade it. Same thing with energy. Energy moved up after hitting some lows right here. Some people are suggesting energy can roll back over. But the way we trade energy, we're directionless, but it's a great way to trade energy the way our style works. And it's not just credit spreads, but it works out very well, and you can do very well in the process that we do. So members, I'll go through this a little bit more detail Sunday evening as well. Okay. So, folks, that's a little bit about where we're sitting. I'm not going to review ag and some of the softs and commodities, but this is where we are right now. Should be a very interesting week coming up. We're kicking off Q2. The watchword in Q2 is going to be where inflation is going to fall. This coming Friday, we get the jobs numbers for the entire month of March. That's going to be a little bit of a clue as far as what the Feds are going to do. But the big one is going to be where's earnings going. And that's going to kick off the second week in April, leading up with the banks kicking things off. Should be an interesting month. All right, everybody, have a really great weekend. Final four. Let's go FAU and Miami. Otherwise, have a great weekend, everybody. I'll see members Sunday evening at 8 p.m. Eastern Standard. Ciao, folks.